Welcome to Deep Dive into Finance channel. Today we will be discussing the concept of pump and dump in finance and investing. This term might sound like it belongs in the gym, but in the financial world it has a completely different meaning. Pump and dump is a scheme that involves inflating the price of an owned stock artificially, through false and misleading positive statements. This pump leads to a surge in price due to enthusiastic investors purchasing the stock. These enthusiastic investors are often lured by the prospect of high returns. Once the price is inflated, the fraudsters dump their shares at this high price, raking in profits. This sudden sell-off often results in the stock price plummeting, leaving those unsuspecting investors at a loss. This scheme has been a part of the financial landscape for quite some time and continues to pose a significant risk. So, to put it simply, a pump and dump scheme is a fraudulent practice where the price of a stock is artificially inflated or pumped up to attract investors. Now that we've introduced the term, let's delve deeper into what exactly happens in a pump and dump scheme. A pump and dump scheme is a fraudulent practice often associated with the stock market, but it can also be found in other investment areas such as cryptocurrencies. It's a two-phase operation, and we'll start with the first phase, aptly named the pump. In the pumping phase, the fraudsters, often large shareholders or individuals with significant influence, start by acquiring a substantial amount of stock in a company. This company is usually small or micro-cap, meaning it's not widely traded and therefore its stock price can be easily manipulated. Once they have a significant stake, the pumping begins. The fraudsters start creating hype around the stock. This could be through positive but misleading or outright false press releases, social media posts, emails, or even telemarketing campaigns. The goal is to create an illusion of a golden opportunity, a chance to invest in a company that's about to hit it big. As the hype builds, other investors, unaware of the scheme, start buying the stock, driving its price up. This is the essence of the pump, artificially inflating the price of the stock through false promotion and deceit. The fraudsters' shares, which they bought at a low price, are now worth significantly more due to the increased demand they have manufactured. Remember, the goal of the fraudsters is not to invest in a promising company, but to inflate the price of a stock they already own. The pumping phase ends when they believe the stock price has reached its peak. That's when the scheme enters its second and final phase. Once the price has been pumped up and the interest of investors has been piqued, we move on to the next phase of the scheme, the dump. So, we've seen how the price of a stock is artificially inflated, but what happens next? Well, this is where the dumping phase comes into play. After the price of the stock has been pumped up to an artificially high level, the fraudsters behind the scheme start to sell off their shares. This is typically done in a very short period of time, often within a matter of hours or even minutes. The sudden influx of shares on the market triggers a swift and dramatic fall in the stock's price. As the share price plummets, the fraudsters pocket the profits made from selling their overpriced shares. As for the unfortunate investors who were lured into buying the stock, they are left holding shares that are now worth significantly less than what they paid for them. It's important to note that the people who lose out in a pump and dump scheme are not just those who bought shares at the inflated price. Even those who bought shares before the scheme was initiated can find themselves at a loss. As the fraudsters sell off their shares, the value of the stock drops below its original price, leaving these investors with shares that are worth less than what they initially invested. The dumping phase of a pump and dump scheme can be devastating for the investors who fall victim to it. Not only do they lose a significant portion of their investment, but they also lose their faith in the financial markets. This can discourage them from investing in the future, which can have a negative impact on their long-term financial health. And it's not just individual investors who suffer. The companies whose stocks are used in these schemes can also be negatively affected. The sudden drop in share price can damage their reputation and make it harder for them to raise capital in the future. And that, in a nutshell, is how a pump and dump scheme works. But how does this affect the wider financial market? It's clear that pump and dump schemes are harmful to individual investors, but they also have a broader impact on the financial market as a whole. Imagine a well-oiled machine running smoothly, with all its parts working in harmony. Now imagine if a wrench were thrown into the works. That's pretty much what a pump and dump scheme does to the financial market. It disrupts the normal functioning of the market, causing instability and uncertainty. The first major impact is the loss of trust. Trust is a fundamental pillar of any financial market. Investors need to have confidence that the market is a fair and level playing field. However, when a pump and dump scheme is executed, it shatters this trust. Investors who have been burned by such schemes may become wary and hesitant, leading to a decrease in market participation. This can result in lower trading volumes and liquidity, making the market less efficient. Secondly, market instability is another critical concern. Pump and dump schemes create artificial volatility. When the pump phase happens, the price of a particular asset skyrockets, only to plummet during the dump phase. This sudden rise and fall can cause panic in the market, leading to erratic buying and selling decisions. Investors who aren't even involved in the scheme can end up suffering losses due to this volatility. Furthermore, these schemes can distort the overall perception of the market. When news breaks out about a pump and dump scheme, it can cast a dark shadow over the entire financial sector. It can lead people to believe that the market is full of scams and fraudulent activities, which is not entirely accurate. This negative perception can deter potential investors, reducing the flow of new capital into the market. Lastly, pump and dump schemes can lead to increased regulatory scrutiny. While regulation is necessary to maintain a fair and transparent market, excessive regulation can hinder market growth and innovation. So, while the perpetrators of a pump and dump scheme may make a quick profit, the overall impact on the financial market is hugely negative. Now that we understand the mechanics and impact of pump and dump schemes, the question remains, how can we avoid falling victim to such schemes? The first line of defense is education. Understanding the signs of a pump and dump scheme can help you identify potential threats before they impact your investments. Look out for stocks that are experiencing a sudden, unexplained increase in price. This could be a sign that the stock is being artificially inflated. Next, be sure to do your own independent research. Don't rely solely on the information provided by others, especially if it's coming from an unknown or unverified source. Dig into the company's financials, check their history, and consider the overall stability of the industry they're in. One of the most effective ways to avoid becoming a victim is to never invest more than you can afford to lose. The allure of quick profits can be enticing, but remember that high returns often come with high risks. Avoiding impulsive decisions is another key strategy. If you see a stock skyrocketing, it's natural to want to jump on the bandwagon. But remember, by the time you see a sudden surge, it's often too late. The dump phase may be just around the corner. Lastly, diversify your portfolio. Spreading your investments across a range of assets can help mitigate the potential impact of a single bad investment. If one stock falls victim to a pump and dump, it's less likely to devastate your entire portfolio. And remember, if something seems too good to be true, it probably is. Sudden and dramatic increases in stock prices, particularly for unknown companies, should always be treated with caution. By keeping these strategies in mind, one can significantly reduce the risk of falling victim to a pump and dump scheme. In conclusion, a pump and dump scheme is a fraudulent practice that can have devastating effects on individual investors and the financial market as a whole. We've unpacked the concept, taking you through the details of the pump phase, where the demand and price of a stock are artificially inflated, to the dump phase, where those behind the scheme sell off their shares, causing the price to plummet. We've examined the impact these schemes have on the financial market, creating volatility and eroding trust. We've also shared some valuable tips on how to avoid falling victim to such schemes, like doing thorough research and being wary of hot tips from unknown sources. After all, your hard-earned money deserves to be invested wisely. So stay informed, stay vigilant, and continue to educate yourself about the intricacies of the financial market. Thank you for joining us on Deep Dive into Finance. Remember, knowledge is power, and understanding the tactics used in pump and dump schemes is the first step towards protecting your investments.